Ronak Onkar, the research head and fund manager at PPSAS Mutual Fund. Ronak, hi and thanks so much for your time. First up, give us a sense of how you are navigating the kind of correction, if you could call it that, once again that we're seeing in the market. Any fresh money that you're deploying given that we continue to be in a slump, or is it more of a wait and watch approach right now?
Hi, thank you for inviting me. You're right, it is more of a wait and watch approach for us. So if you look at our fact sheet over the past year or so, even more than that, we have been sitting on a bit of cash, trying to find better opportunities to deploy money. But on the other hand, wherever we have deployed money, it has always been in areas where we were comfortable with the valuations and the business quality. Some of that includes private sector banks. We have also incrementally added via our dividends in the international stocks. We have also bought a little bit of domestic companies in the auto space over a period of time. So we have added wherever we found valuations to be reasonable. But on a broad basis, it is a very expensive market. Despite the correction, it has not meaningfully corrected to justify the tepid growth that some of these sectors are having in the future. So we will wait and watch till the opportunities come towards us.
Ronak, since you do invest in global markets too and track that very closely, I wanted to figure out what is it that you're making of the trend, that's happening in the US right now. You know, while we are all talking about the S&P and the Nasdaq at record highs, the fact of the matter is that it's those 8 mega caps which are contributing to that, and that's very, very high tech concentration. What's that telling you about, you know, the nature of the rally which is currently at play in the US?
So interestingly, most people think of them as purely tech businesses. But in fact, they enable a lot of uses of tech over a period of time. So if you see the kind of companies in that Mag7, you will have some semiconductor companies whose hardware is required by other companies to implement all the AI tools or even use cloud services. If you look at some of the companies in the digital advertising space, that has been a trend for the longest period of time where traditional media has been losing market share for advertising and eyeballs to social media or digital media. So that trend has been there. And most of the companies who are embracing that, these are enterprises who would otherwise advertise on traditional media, are going towards that. So it's a long-term trend that has been affecting. Then if you see e-commerce as an important trend, that has been a large beneficiary over a long period of time. We have seen sales moving from physical as well as omni-channel and online. So these longer-term trends and software adoption, all of these things are part of the top 8 companies that we see. Of course, one can argue whether the valuations are attractive, which ones are reasonably priced. But I think generally the index will represent some of the burgeoning or upcoming trends, which also show earnings and cash flow growth. So this is not on the basis of just stock prices going up, but also these companies generate a good growth in their cash flows and earnings as well.
Okay, that's a very interesting point, Ronak, that you made. So tell me, out of the Mega7 in the US, looking at the entire supply chain, any Indian companies or any Indian connect that one can make, and investors here can look at those names?
I think in many spaces, for example, in the Mega7, unfortunately, at this moment, we have been users of these technologies and services. We have not been path-breaking in terms of having our technology stacking up to the tech of some of these larger companies. But it's slow progress. So we are developing a very strong manufacturing backbone. We already have a good services backbone. In fact, if you look at some of the chip design companies, bulk of their chip designing staff also resides in India. They have had GCCs in India for the longest period of time. So we have the technical engineering talent. We just need to scale up on the other parts of the supply chain and maybe become as relevant as some of these large giants are.
All right. Hi, Ronak. And good to be speaking with you. I remember the last time we interacted was back then when we discussed this whole India and China EV story playing out and the comparison, of course. But with this whole GST rollout, Ronak, what's your current take on autos? Have you added anything afresh in your portfolio, be it from the auto or the auto ancillary space? And the other question is with respect to the EV players. Earlier, they used to demand a premium with the kind of growth opportunity that lies ahead. But with this ICE rates and the GST reset, do you believe EVs will continue to demand that premium, or that time is gone?
To answer to your first question, we have not lately added to the auto positions that we have. We already have sizable holdings in Mahindra and Maruti Suzuki. But to answer your EV question, I think EV should not be looked at from a quarterly or a news flow kind of a time period. Let's zoom out a little bit and take a longer term view. Just 3-4 years back, we did not even have technology indigenous to us. Now we have a lot of manufacturing happening in India, but also we depend a lot on imports today. That is being corrected over a period of time. So just like the ICE ecosystem has been built in our country, we are seeing the EV ecosystem also being built in the country, both on two-wheelers as well as four-wheelers. And whatever small resets in GST and all these things happen, we should not forget that we still are increasing our power supply given to the citizens of the country. We are also trying to build our grid and make sure that we have more transmission points. We are also seeing a lot of demand on power from other areas like data centers, etc. So we need to make sure that the infrastructure is available for the rollout of EV services. So we need to give it a time to see how the EV adoption happens. And in the end, the products have to speak for themselves. The companies who are putting these products out, they have been in various iterations of these products. So they will see how these products perform, they will refine and improve. And imagine what we had 3 years back and how many EVs we have in India today and how they look and what kind of features they have. It's quite astounding to see the development, and I think we should wait and watch for a longer period of time, but be positioned in that. So both the companies we own, one of them is a ICE leader and the other one is now growing in the EV space. So we'll see how both these things play out.
Right, and Ronak, given the way you have been allocating funds within your portfolio at a time like this when the markets have largely been in a lull and not much is happening, do you believe it would be safer to now invest money into gilt-edged securities or towards the debt side compared to equities?
Debt has been a very attractive place. So if you see some of our cash holdings, they're also in the form of CDs and CPs, which are shorter term oriented. So it's not necessary that the fund, when it keeps money idle, it invests only in money market securities, but you can actually get a little bit higher return by investing in debt securities. But if you look at hybrid funds that we have in the portfolio, we have been advocating for a while that it's a great time to reallocate to debt because in the last few years, if your equity allocation has gone askew because of the one-way move the market has had, maybe it's a good time to reallocate the assets to balance between your equity and debt allocations.
Okay, so that's the take coming in on how you have been deploying in your portfolio, and of course gilt-edged and debt looking more attractive right now. In terms of your portfolio allocation, when I see it's got names like arbitrage, you've got diversified FMCG, consumable fuels. I want to discuss more about diversified FMCG, Ronak. What exactly would constitute or would fall under this umbrella? And given the GST cut that we've seen, also the RBI front loading happening, you also have income tax cuts that coming in. Would you rather play the discretionary theme right now? Is that something that you're eyeing?
We would love to play the FMCG theme. In fact, these are some of the most stable consumer companies with great cash flow opportunity over a long period of time. But unfortunately, if you look at the entire consumer space, for the past 4 or 5 years, it has been extremely expensive and way beyond the comfortable valuation zone. So the only consumer stock you will find in our portfolio is ITC, which we also started accumulating somewhere in the COVID crash. In fact, that was the most reasonable consumer stock we could buy at that time. And we still continue to hold a chunk of it because the cash flows have been good, the capital allocation has been sound, and the dividend policy has been revised. So it's a good play, still reasonably priced compared to other consumer plays. But yeah, despite the quality of the business and the quality of management and consumers, the valuations are extremely stretched. So we have generally stayed away from them.
Right. Okay. Ronak, what happens to the entire defense, railway, shipbuilding, that entire pack? Frenzied and fancied once upon a time. You know, people learned their lessons, burned their fingers, and now again you are seeing tremendous order flow and even stock price move.
So interestingly, the stock is not the business, right? The stock might have expectations built into it, but the business has to prove over a long period of time. So some of these trends are in the right direction. We just need to give it time to see the actual cash flows coming in, actual orders converting to cash, technology transfer to Indian companies, even some indigenous technology growing from India. So we have a lot of these pieces in place, just like in the other manufacturing ecosystem. But over here as well, maybe the expectations are a little bit ahead of what is actually being delivered. But it's the right direction in my view. In the long run, I think we will be a stronger country if we have indigenous manufacturing in India for defense development as well.
All right, Ronak, so good having you on the channel today. Thank you so much for your time and speaking with us.
Thank you.
Now shifting focus to on HSBC note, where HSBC has come out with a note on the equity strategy, and they have upgraded the India to overweight from the neutral rating, citing that the valuation has normalized and government policy is supportive and the foreign positioning remains light. For the Sensex 2025, they are given a target of 85,130, and for the year end of 2026, their Sensex target is 94,000. And on the earning, they have said they say that the 2025 consensus earning growth forecast have been cut to 12%, they expect further downside of 8 to 9%. But for 2026, they estimate to a 15% earning growth may be optimistic, and realization depends on the government policy effectiveness in the reviving growth. And they say that the growth recovery is expected to be gradual, but the risks are already reflected on the valuation. Now on the tariff, they said that a key overhang on 50% tariff to imports from India, and India faced some of the highest US tariff rates globally. However, the direct impact of the US tariff is limited, and less than 4% of BSE 500 companies sales come from the export of the US. So, and most listed Indian equities are domestic driven, demand driven. So they say that the US direct impact to the Indian companies is limited.
Well, thanks so much for taking us through that. Let's take the conversation ahead with the author of this note coming in, an important HSBC upgrade coming in on the Indian economy and the Indian markets. We have joining with us Harold van der Lind, the head of equity strategy at Asia Pacific HSBC. Harold, hi. And thanks so much for your time. It's an interesting note you've got there, an upgrade coming in for India, and you've also called India to be the quiet space amidst all its pan-Asian peers. Give us your take on what is boosting this optimism, and especially the 94,000 target for Sensex by the end of next year.
Well, thank you, and good morning to you as well. And thanks for having me on. India is a quiet corner. If you look at, I think with one of your previous people that you interviewed, you were talking about how concentrated the US market is. So it is with Asian markets. They're also super concentrated. Where are people concentrated? They're in Korea and in Taiwan, because that's where the AI story to a large extent is unfolding, and China to a certain extent maybe as well. But if you look at, for example, just give you a bit of backdrop, Hynix in Korea is now the second biggest overweight for all funds, GEM funds globally. TSMC, the largest stock in Taiwan, most funds have about 10% of their portfolio in that particular stock alone. So it's a really concentrated bet. And where do they go to? That's India. They've sold India. They've reduced their weightings on India. And our suspicion is that that's going to reverse. That people are going to go back to India and that they actually take money, not so much out of China, but I think maybe out of Korea or a little bit out of Taiwan as well.
But Harold, what is the view on India when you compare it with other emerging markets? I mean, the likes of China, Korea, Japan, or rather some of the developed markets as well, like Japan, Argentina, what we're seeing in that market, or some of the other South American markets as well. Because the concern for India has always been the earnings slowdown, a lot of the money actually moving to the primary markets as opposed to finding its way into the secondary markets, and valuation when it comes to India always seems to be a concern.
You're right to say always a concern. There's a very good reason for it, a couple of reasons. Indian companies belong to the most profitable on the planet, so they deserve a premium. Secondly, India also has sort of capital control, so you get a sort of, how do you say that? You get the effect of when the money can't leave, and therefore it pushes these valuations on. So we have to take that into consideration. The earnings story in India is different, and I actually think it's not that bad. Yes, earnings are being downgraded. We actually became cautious on India exactly a year ago when we felt that earnings expectations were way too high. And then we looked at, say, 2025, people thinking 18% earnings growth is not going to happen. So we felt there was a risk. That is why we were cautious for the last 12, 14 months or so. But now these earnings have already been cut. So instead of 18%, they're looking at 11 or 12%. We think probably is going to bottom out at about 8 or 9%. Next year, the number is 15%, a bit too high, but probably 13 might be achievable. So we're very close to the bottom of the earnings growth cycle. That doesn't mean it's going to turn around very quickly. It might take a couple of quarters, but you can see that the levers that are going to drive that recovery are there. You see lower interest rates, you see fiscal stimulus. So I think that the story in India is gradually moving in the right direction. While 12 months or 14 months ago, we felt everybody liked it at the time, we felt there was a bit too much euphoria, and now it's almost the opposite.
Right, okay, so that's the take coming in. Harold, I've been going through your note and I notice you have an underweight coming in on the Japanese market. Now, with the way the Nikkei has performed recently, consistent all-time high, fresh highs coming in for the Nikkei almost every day now for the last couple of weeks, are you going to be changing the way you are viewing the Japanese markets anytime soon?
No, I think the Japanese market is to a very large extension a reflection of what happens with the yen. There's also corporate governance change, a couple of other things, but the yen is one of the key drivers there. And a weaker yen is good for the market, and a stronger yen is not so good for the market. And on the margin, we think the yen is not really going to strengthen that much, but a little bit more. Also, investors have taken the incremental dollar that they can invest and have not put it into the US, but into Europe and Japan. So they build up positions there. And I think as we go into the latter part of 2025 and in 2026, that money might start to flow into emerging markets, which is also, again, a positive for India.
The other thing that I wanted to talk about, Harold, when it comes to India especially, is that still overhang of the 50% tariffs that have been imposed on India. A resolution could come about. We don't know when, and we don't know the nature of that resolution. How significant is the impact of these tariffs on the Indian economy, you think?
Yeah, so these tariffs, I also have no idea what they're going to go to. If I have to make a guess, or I have to say they're going to go up or down, I think they're going to go down from here. But I'm not a political analyst, so it's not that I have any particular insight into that. So we'll see. But the market knows this, so this is priced in. So we are aware of that. Also, the actual impact of that tariff on the earnings in India is limited because the vast majority of Indian companies sell their products domestically. They sell shampoo or jewelry or cars in the domestic market. They are not really impacted by these tariffs. The ones that are impacted are the ones, of course, that export to the US. But some of your sectors are being excluded from this as well. So the actual impact on earnings is not as big. It is just a sort of sentiment thing that hangs over the market. And if these tariffs would come down, yeah, that sentiment would improve. But let's wait and see until that really happens, because we just don't know when that takes place. So I'm not overly concerned about this. I'm really looking at what in the longer term drives equities, and that's really domestic interest rates, global interest rates, and the earnings in the market. And all of these factors look pretty okay for India at the moment.
Right. Harold, I want to talk to you about the foreign fund flow activity that we've been seeing in the Asian markets. Year to date, these markets are up on an average about 20% despite FIIs largely being sellers, as has been the case with the Indian markets as well. What do you think the concern here is? Is it fundamentals? Is it elevated valuations? Is it policy? What could be the hold-up here, and are you seeing this trend reversing anytime soon?
No, I think what has happened in large parts of Asia, India might be a bit of an exception to this, but what's happened in large parts of Asia is that a lot of people think in particular about China over the last couple of years. China was going through a very difficult rough patch. What do? You don't do anything with your money. You don't invest. Because your property was going down, your stocks were going down, you might lose your job. So what did people do? They put their money in the bank and didn't do anything with it. Indeed, that was the best decision to do, because in China you got deflation as well. That means your dollar today is worth even more tomorrow because the prices are going down. You can buy more with it tomorrow. So that's what they've done. And now an enormous amount of cash is sitting on these balance sheets in China, on the banks. These households hold about $22 trillion of cash, of which we think $6 trillion could be invested in equities or bonds, or bonds don't give you any money, so equities, gold, property, anything else they want, crypto for my part. And we're starting to see this gradual reallocation. and that's going to be supporting these markets. So that's one thing. And you see that similar sort of theme whereby the locals are coming out and trying to put their cash at work. You see this a little bit in Korea as well. You see this in Taiwan to a certain extent. ASEAN so, not so much. And in India, that has been a key driver. So in that sense, what we see in other parts of Asia, we've seen with India over the last couple of years. And I think those domestic buyers in India, they will eventually come back into the market as well.
Interesting. So, Harold, in lieu of your target on India Sensex over the next 1 year, I wanted to understand, where do you see leadership amid sectors? And would you say that financials will be the one driving the rally? Or could it be some of the other consumption plays?
There's a couple of interesting domestic sectors I would be looking at. I mean, selected banks don't look overly expensive to me. You see a little bit of consolidation in the cement industry, so that's where I would look at. Some of the consumer names in India look pretty good. Some of the mall operators, for example, as well. And one of the stories I really like in the medium term for India is medical tourism. Medical tourism is already a really big thing in parts of Asia. I think in India it is just starting. That foreigners go to India for some tiny surgery, for some of your hospitals. I suspect actually the foreign contribution is at best maybe 5% or so or something of sales. But it's a really big thing in Singapore now, in Malaysia, in Korea. Korea is really good on plastic surgery and these sort of things. People fly from Indonesia to Korea to get a couple of injections into whatever they want to change, right? And why not then fly to India to get I don't know, if you need to do something on your lungs, your heart, or anything else. So that's something I would be looking at as well, hospitals.
So looking interesting in medical tourism, of course, emerging as one of the key new tourism sectors. But Harold, when we spoke about Japan, you spoke about concerns around the yen and the entire yen carry trade that we've been seeing. But if you shift focus to India, the rupee is also losing ground against the dollar. What do you have to make of the currency back home, and where do you think that trade is headed?
So the key difference between India and Japan in the sense is that Japan is an exporting stock market. The vast majority of companies listed on that market are exporters. Think about some of the electronic giants and the auto companies. They sell, of course, in Japan, but the big market is really the US and Europe, China. And that means if you have a weaker yen, that's good for them. So the weaker yen is supportive to the equity market. In India, it's always the opposite. A weaker yen is not necessarily that bad, but you have most of your companies are domestic-oriented companies. Exporters are a much smaller part. That's mostly, as you know better than I, the pharma and some of the IT companies. So the dynamics in that sense are very different. Also, the way Japan manages its currency is very different than India does. So Korea and Taiwan is the same. So the dynamics are very, very different. In India, you might get a weaker rupee. I'm not overly worried about that. As long as the valuations are cheap enough, we know that in US dollar terms, you can make good money as long as your entry point, your valuations is pretty good. And I think that's where we are now. Entry points are good when people don't like the market, they're underweight. But we see signs that things are starting to improve. It's that sort of inflection point where I think India is at the moment.
Okay, Harold, great chatting with you. Thanks for your time today.
Thank you for having me.
Your GPS knows the roads, but not the off-roads. That's why you need grip that never quits. Seat Cross Drive. Grip you can trust.